The Psychology of Investing. Chapter 6. Patience as a Strategic Advantage. Compounding is often described as a math concept, but in real life, it is also a behavior concept. Your money can only keep building on past gains if you stay invested long enough for that process to continue. That means time matters, but stability matters too. When fear makes you sell after a decline, or excitement pushes you to jump in and out of investments, you interrupt the very process that creates long-term growth. A good plan does not need constant emotional input. It usually needs protection from it. Compounding is simply returns earning returns. If $100 grows by 5%, it becomes $105, and the next gain is earned on that larger amount, not the original balance. At first, that can feel unimpressive because the early dollar gains are small. But the base slowly gets bigger, and each future return has more money to work on. Over many years, that quiet accumulation becomes powerful. The lesson is that modest progress can become meaningful when it's given enough time to keep building. Both fear and excitement can be expensive, even though they feel very different in the moment. Fear can push you to sell after prices have already fallen, which turns a temporary decline into a permanent loss.
Excitement can pull you into buying after a surge, when prices may already be elevated.
If those reactions happen again and again, compounding keeps getting interrupted. The damage is often subtle, because each decision can seem reasonable by itself. Over time, though, fewer emotion-driven moves usually leave more wealth intact. Patience is not just a personality trait in investing. It is a practical edge. A quiet strategy that keeps contributing, resists panic, and avoids chasing whatever recently did well can outperform a much busier approach. That is not because inactivity is magical. It is because unnecessary changes often create mistakes, costs, and lost time. When you let time and discipline work together, you give compounding a better chance to do its job. In that sense, patience is not passive at all. One of the best ways to stay calm later is to make decisions earlier. A written plan helps because it answers important questions before markets become stressful or exciting. You can decide how much to invest, how often to invest, what you will own, and the time horizon you are actually investing for. When volatility arrives, the plan becomes an anchor. Instead of asking, "What do I feel like doing today?" you can ask, "Does anything here truly require a change?" That small shift can make emotional moments much easier to manage. Short-term market moves are loud, but they are not always meaningful. Prices can swing daily for reasons that have little to do with your long-term goals, including headlines, sentiment, and short-lived reactions. A brief drop does not automatically mean the value of your plan has changed. Very often, daily prices are just distractions competing for your attention. Long-term investing works better when you judge progress over years instead of days. Treating every wiggle as important makes patience much harder than it needs to be. Discipline is tested in two kinds of markets, not just one. In declines, fear tells you the plan must be broken. In surges, greed tells you that you are missing out and need to act quickly. But a 10% drop does not automatically mean your strategy failed, and a rapid rise does not automatically mean you should chase. The better response in both cases is to check whether your goals, timeline, and risk level still fit. If the plan still makes sense, boring consistency is often the smartest move. Maria's example shows what disciplined investing can look like in real life. She puts $500 a month into a broad index fund and keeps going through both good periods and bad ones. After the first year, she has contributed $6,000, but the account is only worth about $5,400, which can feel discouraging. By year 5, her contributions total $30,000, and the account has grown to about $36,000. In year 8, the balance falls sharply from about $60,000 to $42,000, yet she keeps investing. By year 10, she has contributed $60,000, and the account is worth about $82,000, showing that consistency mattered more than prediction. What makes Maria's story especially useful is seeing the cost of stepping out. If she had sold after the decline in year 8, she might have felt safer for a while. But recoveries often begin before people feel comfortable enough to get back in. Missing even part of that rebound means less money is available to compound afterward. That creates a gap that can keep widening for years. In this kind of example, one emotional exit can easily cost around $10,000 later. Not because of one terrible investment, but because of lost recovery and lost time. Patience becomes much easier when it is turned into a routine instead of a heroic act. Start by naming the investing fear that affects you most, whether that is losing money, missing out, or making a mistake. Then write one clear rule designed for that fear, such as waiting before making changes, or refusing to sell during a sharp drop without a full review. It also helps to estimate the cost of past emotional decisions, because that makes the lesson concrete. Finally, give yourself a regular review rhythm, such as once a quarter. Rules and routines make calm behavior repeatable. Patience should not be confused with ignoring your investments. The goal is to give a sound plan time to work without disrupting it every time discomfort appears. Common mistakes include checking accounts too often, treating volatility like permanent loss, chasing recent winners, or letting headlines force strategy changes. Each of those habits increases the odds of interrupting compounding. Patient investors still monitor what they own, but they do it with perspective and purpose. Calm behavior is what protects the long-term process. Patience has another advantage that is easy to miss. It reduces friction. Trading can feel productive because you are doing something, but every trade creates costs that work against your returns. Some costs are obvious, like fees, and others are less visible, like spreads and taxes. The more often you trade, the more often those frictions repeat. That means less of your money stays invested and available to grow. Over time, the real damage is not just what you pay out today, but what that money never gets the chance to become. The three main trading frictions are commissions, bid-ask spreads, and taxes. Commissions are the direct fees charged to place trades, though in some accounts they may be low or even appear to be zero. The spread is the hidden gap between the price buyers pay and the price sellers receive, and that cost shows up on every trade. Taxes can be triggered when gains are realized, especially if positions are sold frequently. Each of these may look small in isolation, but when they happen repeatedly, they compound into a meaningful drag on long-term returns. Commissions and spreads are a good reminder that small costs do not stay small when behavior repeats them. A commission is straightforward. It is the fee attached to the trade itself. A spread is more subtle, because you may buy at a slightly higher price and sell at a slightly lower one, which quietly reduces performance. In less liquid assets, that gap can be wider, making the hidden cost larger. One or two trades may not matter much. Frequent activity, though, can turn minor frictions into a persistent headwind against your portfolio.
Taxes are often the biggest hidden cost because they reduce what you actually keep.
When you sell at a gain, you may create a tax bill, and short-term gains are often taxed more heavily than long-term gains. That means two investors can make the same investment decision and still end up with different after-tax results depending on how long they held it. Frequent selling can shrink returns sharply, even if the trades feel successful before taxes. A patient holding period can leave more of the gain in your account. In investing, what matters is not just the return you earn, but the return you keep. The deeper problem with trading costs is not only the money lost today, it is the compounding that money never gets to do in the future. If costs reduce the amount left invested, all future growth starts from a smaller base. Even a small annual drag can widen into a large long-term gap, because time magnifies recurring differences. This is why frequent trading can be so expensive, even when each individual cost seems manageable. Money paid in friction disappears twice, once when it leaves the portfolio, and again when it misses years of potential growth. A simple way to estimate trading friction is to break it into pieces. First, add the visible and hidden costs of one trade, including any commission, the likely spread, and any tax impact from realizing gains. Then multiply that by how often you expect to trade over a year. That gives you a clearer estimate of the annual drag caused by activity. After that, ask a more important question. What future value might that money have reached if it had stayed invested instead? This exercise turns vague concern into a concrete number, which often makes the cost of overtrading much easier to see. Consider a simple example. Maria starts with $10,000 and trades frequently, making 52 trades in a year. Her commissions and spreads add up to $572, and her short-term gains tax adds another $440. That brings her total annual friction to $1,012. On a $10,000 portfolio, that is roughly 10% lost to activity before long-term compounding can help. The point is not that every trader will face the exact same numbers.
It is that repeated action can create a surprisingly large drag very quickly.
Now compare that to Derek, who buys a broad index fund and mostly holds it. Because he avoids repeated trading costs, more of his money remains invested and available to compound. If his portfolio grows at 7% for 10 years, he ends up with about $19,672. Maria, with heavy friction reducing what stays invested, ends up around $13,526. That is a gap of more than $6,000 from behavior, not necessarily from superior market insight. Patient investing keeps more dollars working instead of leaking out. This is why patience becomes a real advantage, not just a nice idea. Active trading has to overcome more than normal market uncertainty. It must first beat commissions, spreads, taxes, and the lost compounding caused by those costs. That creates a built-in hurdle before the strategy can even begin to outperform. Buy and hold lowers that hurdle because fewer dollars are lost to friction. The less your portfolio has to fight against, the easier it is for ordinary market growth to help you. Sometimes the winning move is simply removing the obstacles you created yourself. Many investors make the same mistake with trading costs. They underestimate small, recurring frictions. They may focus only on commissions and ignore spreads, or assume commission-free trading means trading is truly cost-free. Others treat activity as progress, as if more decisions must mean better results. But hidden costs and repeated taxes can matter far more than a visible fee. The important habit is to measure total friction, not just the part that is easiest to notice. In long-term investing, small leaks deserve attention because they can drain a lot over time. Try the calculation for yourself. Suppose you make 30 trades, and each trade creates $8 in one cost and $1 in another, for a total of $270. If you also realize $1,500 of short-term gains taxed at 22%, that adds another $330.
Your total annual friction becomes $600. Then compare what happens over 5 years with and without that drag. A simple exercise like this makes an abstract idea visible and shows how recurring costs weaken compounding year after year. Underneath all of this is a basic investing challenge, choosing a smaller reward now or a potentially larger reward later. Short-term wins feel satisfying because they provide quick feedback and a sense of control. But long-term wealth usually comes from allowing money to stay invested and compound, rather than constantly harvesting small emotional rewards. Frequent reactions can interrupt that process before it matures. Time does a great deal of the heavy lifting in investing, but only if you let it. Delayed gratification is really the skill of protecting future growth from present impulses. Quick wins are tempting because markets are full of stories that make immediate action feel smart. A fast-rising stock grabs attention, urgent headlines create pressure, and a small gain can feel like proof that you are making progress. Psychologically, that is powerful because the reward is immediate and visible. The problem is that impulse can start to outrun strategy. A move that feels exciting today may have very little to do with your actual long-term goals. Recognizing that pull is important because temptation is easier to manage when you can see it clearly. Compounding needs time in the same way a tree needs time. If you keep pulling it up to check whether it is growing, you limit what it can become. Investments work similarly because returns build on prior gains only when the process stays intact. Early interruptions reduce the size of the base that future growth can build from. Patience does not make progress instant, but it allows the process to mature. Long-term investing often looks slow up close and impressive from a distance. Delaying gratification does not mean neglecting your portfolio. It means refusing to let short-term noise overrule a plan that was designed thoughtfully. Real patience includes setting an appropriate mix of investments, contributing consistently, reinvesting earnings, and giving the strategy time to work. That is active discipline, not passive avoidance. You are still engaged, but you are engaged at the right level. The goal is not to stop caring. The goal is to care in a way that supports compounding instead of constantly interrupting it. There is a difference between passive patience and active patience. Passive patience just waits and hopes, often without a clear routine or a reasoned plan. Active patience, by contrast, stays connected to the strategy, while avoiding impulsive reactions. It means rebalancing on schedule, continuing contributions during declines, and making changes only when the plan actually calls for them. So patience is not simply sitting still. The better version is purposeful waiting, where discipline stays in charge even when emotions are present. Patience becomes much easier when it is supported by a system. Start with a clear goal and a time horizon so you know what the money is for and how long it has to work. Keep the portfolio simple and diversified so you are less likely to tinker constantly. Write rules for when changes are allowed, such as a scheduled rebalance or a genuine life event. Then automate contributions and reinvestment where possible. Structure reduces the number of emotional decisions you have to make, which means willpower does not have to do all the work. A practical way to strengthen patience is to create distance between feeling and action.
If you check performance constantly, normal volatility can start to feel urgent, even when nothing meaningful has changed.
A set review schedule helps because it reduces random emotional decision points.
Adding a pause, such as waiting 48 hours before a major trade, gives your thinking time to cool down.
Revisiting the plan before acting also shifts your attention from the latest market move to the reason you invested in the first place.
Small process changes can sharply reduce impulsive behavior. Anna's example brings these ideas together. She is 30 years old, investing $500 a month for retirement at 65 in a diversified mix of a total stock market index fund and a bond fund. When a friend points out a fast-rising stock, she does not act immediately. She waits 48 hours, reviews her goal, and realizes the hot tip does not fit the plan. In her first year, she contributes $6,000, and after 8% growth, the account is worth about $6,240. 10 years later, her account grows to over $85,000, showing how consistency and restraint can matter more than excitement. Delayed gratification is not only about resisting dramatic market moves. It also shows up in small, everyday choices. If someone invests $150 a month for 20 years, instead of repeatedly spending it, the total contribution is about $36,000. At roughly 7% growth, that can become about $77,000. The future reward is much larger than the monthly decision feels in the moment. This is not about denying every pleasure. It is about recognizing that repeated trade-offs, supported by a system, can become meaningful long-term outcomes. Patience gets weaker when common habits quietly undermine it. One mistake is confusing patience with neglect and failing to monitor the plan at all. Another is selling during declines out of fear, which can lock in losses and interrupt recovery. Chasing what feels exciting is also dangerous, because excitement is not the same as strategy, and many people abandon a reasonable plan too quickly before time has had a chance to work. Patience is strongest when it is paired with clear goals, automation, and fewer emotional decisions. One of the easiest ways to support patience is to reduce how many decisions you must make. Manual investing creates repeated moments for second guessing, especially when markets are falling or rising fast. Fear can delay investing during downturns, and excitement can cause late buying after prices have already moved higher. Automation helps by replacing many of those emotional moments with preset rules.
Instead of deciding over and over, you decide once and let the process continue. That does not remove uncertainty from markets, but it can remove a lot of unnecessary behavioral risk. A rule-based investing process can be very simple. You choose a fixed contribution amount, set a regular schedule, and have money move automatically from your bank account into your investment account. The purpose is not to guess the best moment to invest. It is to stay consistent through many different market conditions. By letting the plan run in the background, you reduce the influence of headlines and mood. Consistency often matters more than timing, especially when the goal is years away. Automation often pairs naturally with dollar-cost averaging. This means investing the same dollar amount at regular intervals, so the number of shares you buy changes with the price. When prices are high, the fixed contribution buys fewer shares. When prices are lower, it buys more shares. That spreads purchases across different market conditions, instead of forcing you to guess the perfect entry point. The main value is behavioral. It encourages disciplined participation. It is not a guarantee of better returns, but it can be a very helpful way to stay invested. It is important to be clear about what automation can and cannot do. It does not guarantee higher returns,
and it does not predict market movements for you. What it does do is reduce the urge to time the market and help maintain steady contributions when emotions are strongest. That steady behavior can be especially valuable during volatility, when manual investors are often tempted to pause or chase. So the strength of automation is not magic performance. Its strength is making good behavior easier to repeat. Downturns feel uncomfortable, but for long-term investors who keep contributing, they can also create opportunity. A fixed contribution buys more shares when prices are lower than when prices are high. If the market eventually recovers, those extra shares can help long-term results. Automation matters here because it keeps the plan going through the uncomfortable part. That does not make declines pleasant, and it does not guarantee a quick rebound, but it does help patience remain in place when it matters most. Automated investing works best with money that can stay invested for years. If you may need the cash soon, a market decline could force you to sell at the wrong time, which defeats the purpose of a long-term plan. That is why an emergency fund and near-term spending needs should usually be covered first. A horizon of at least 3 to 5 years is often more suitable for automated market investing. In other words, automation is most helpful when the money has time to ride through normal ups and downs. Matching the tool to the time horizon is part of using it wisely. Setting up an automated plan is usually simpler than people expect. Start with an amount you can sustain comfortably, because consistency matters more than ambition you cannot maintain. Choose a regular date, often just after payday, and link your bank account to your investment account. Use one simple diversified fund if that fits your strategy, such as a broad index fund or a target date fund. Then leave yourself only a light review schedule, maybe once or twice a year. A simple plan is easier to follow, and easier plans tend to survive real life better. Maya's example shows how automatic investing works in practice. She sets up $300 a month into a total stock market index fund and lets the process continue regardless of market mood. If the share price is $50, her contribution buys 6 shares. At $40, it buys 7.5 shares, and at $60, it buys 5 shares. Over the year, she invests $3,600 without having to guess the right time. The system keeps working, whether prices are high or low. What Maya's example really shows is a reduction in behavioral risk. She bought across many different prices, so she did not need to predict the market correctly to keep making progress. Automation kept her participating through declines and recoveries alike. That matters because hesitation during rough periods can be costly if it causes missed opportunities to keep investing. Her steady behavior may end up being more important than any clever market call she could have tried to make. In investing, consistency is often more valuable than drama. Before automating, it helps to write the plan down in plain language. Choose a monthly amount you can actually sustain. Pick a transfer date that follows your paycheck, and select one low-cost diversified fund that fits the goal. Then write a simple commitment statement so the plan feels intentional rather than vague. It might be as straightforward as promising to invest a certain amount each month automatically. Finally, set a review date in 6 months. A written plan makes the system easier to begin and easier to trust when emotions eventually show up. Automation works best when it stays simple, affordable, and monitored calmly. One mistake is ignoring the account forever, because even good systems still need occasional review. Another is starting with too much, which can make the plan feel painful and increase the odds that you stop it. It is also risky to invest before building emergency savings, or to overcomplicate things with too many funds. And one of the most damaging mistakes is turning the system off during a market crash. Good automation is not set and forget. It is set, support, and stay with it. Even with a good plan in place, one habit can still create trouble: checking too often. Frequent checking makes normal market noise feel emotionally important. A small daily loss can feel like danger, and a small gain can create overconfidence. The more often you look, the more often you invite a reaction. That can create a cycle of price change, emotion, action, and regret. For long-term investors, too much attention can become its own source of risk. Reviewing less often can be a strategic advantage because it reduces the number of emotional jolts you experience. Fewer checks often mean less stress, and less stress can mean fewer impulsive trades. Long-term plans are not improved by constant judgment every time the market moves. They are usually improved by patience and steady follow-through. A calmer process makes it easier to stay aligned with the original strategy.
Sometimes protecting results means protecting yourself from unnecessary stimulation.
Of course, reviewing less does not mean ignoring your investments. The goal is deliberate monitoring, not neglect. Daily prices rarely matter for distant goals like retirement, but scheduled reviews can still be very useful for checking progress, allocation, and life changes. The key is to review with a purpose, instead of out of habit or anxiety. When reviews are scheduled rather than reactive, you are less likely to confuse motion with meaning. That small shift changes investing from a reflex into a process. There is a strong psychological reason this approach works. First, short-term volatility looks much more intense when you examine it up close every day. Over longer periods, the same investment path often appears smoother and more manageable. Second, losses usually feel stronger than gains of the same size. If you check frequently, you expose yourself to more moments that feel like losses, which can make investing seem riskier than it really is. Less frequent review can reduce those emotional hits and support better behavior. The right review schedule depends on the goal and the time horizon. Money needed soon may justify more monitoring because decisions could actually be required in the near term. A retirement account with decades to run usually does not need that kind of attention, so quarterly or even annual reviews may be enough. Goals in the middle, like a home down payment, may fit somewhere between. The key principle is simple: review for decision-making, not for anxiety relief. Monitoring should serve the goal, not your momentary curiosity. If checking has become a reflex, adding a little friction can help. Turn off market alerts, so every move does not arrive as a prompt to react. Move investment apps off your home screen, or even log out after each scheduled review. You can also limit the news habits that reliably trigger the urge to check your account. These changes are small, but they interrupt automatic behavior. In investing, a little inconvenience can sometimes protect a lot of discipline. When the scheduled review does arrive, make it count by focusing on questions that actually matter. Ask whether you are still on track for your goal, whether your allocation has drifted meaningfully, and whether your circumstances have changed. Those are useful reasons to act. Daily price changes, by contrast, usually are not. And if nothing material has changed, doing nothing may be the correct decision. A good review is not about finding a reason to trade. It is about checking whether the plan still fits. Headlines often create a false sense of urgency. Dramatic news can make it seem as though immediate action is responsible, even when a diversified, long-term portfolio was built to handle routine shocks. Urgent does not always mean important. Between scheduled reviews, it can help to pause and let emotion cool before making changes. Most news does not require a long-term investor to do anything right away. Better decisions usually come from calm review, not from reacting at headline speed. Mia's experience shows how a small process change can improve behavior. She used to check her portfolio daily, and after seeing a 3% drop, she sold. Stocks later rebounded, and she missed the gains that followed. After that, she shifted to quarterly reviews and reduced her alerts. At the next review, instead of panic selling, she noticed a modest allocation drift and rebalanced calmly. The market did not become less volatile. Her process simply became less reactive. A practical way to test this idea is with a 1-month experiment. In the first week, reduce checking from daily to weekly. For the rest of the month, check only twice on set dates. Before each check, write down what you expect to feel or see. After each check, record the portfolio value, your emotions, and any urge to trade. This turns vague impressions into evidence and helps you notice whether less checking reduces stress and temptation. The challenge is sticking to the schedule, especially when markets get noisy. One common trap is the unscheduled just once check, which often reopens the habit you were trying to reduce. Another is confusing less review with no review at all, which turns discipline into neglect. Headlines can also tempt you to override your process, particularly during volatile periods. And many investors start checking more often, precisely when they most need calm. A review schedule only works if you protect it when emotions rise.